Do you know that the most comprehensive study of actual millionaires in American history found that most of them drive ordinary cars, live in ordinary suburbs, wear ordinary clothes, and spend less money per year than people who earn a fraction of what they earn? In the 1990s, Thomas J. Stanley and William D. Danko spent 2 decades tracking down and interviewing American millionaires. Not the flashy ones, not the celebrities or the hedge fund managers or the tech billionaires. The real ones. The ones with a net worth of $1 million or more who lived, and this was the surprise, in houses worth far less than their wealth would allow, in neighborhoods far more modest than their income suggested, driving cars they had often owned for a decade. Their findings demolished almost everything popular culture said about wealth. They published the results in 1996 as The Millionaire Next Door, The Surprising Secrets of America's Wealthy. It became one of the best-selling books about personal finance in American history. It still sells, and the reason it still sells is that the lessons it documents are not about tactics. They are not about which investment to buy or which tax strategy to use. They are about something more fundamental: the difference between people who accumulate wealth and people who display wealth, and why those two groups almost never overlap. This video is a full breakdown of what Stanley and Danko found: the methodology, the data, the profiles, the 7 common denominators of American millionaires, the concept of the under-accumulator of wealth versus the prodigious accumulator of wealth, the role of lifestyle inflation in wealth destruction, the surprising demographics of who is actually wealthy in America, and what all of it means for how you think about your own financial life. The research began, as much of the best research does, with a faulty assumption that turned out to be more interesting than the answer the researchers expected. Stanley and Danko were market researchers. They had been hired by financial services companies to help them identify wealthy consumers, people with large investable assets who might want to buy financial products. The assumption was that wealthy people would be found in wealthy neighborhoods, that if you wanted to find a millionaire, you would go to a rich suburb, a luxury apartment building, a neighborhood with expensive cars in the driveways. They went to those neighborhoods. They conducted surveys and interviews, and they found that the wealthy areas contained many people who earned a lot of money, but relatively few people who had accumulated substantial wealth. Then they noticed something. The research kept turning up significant concentrations of millionaires in places that the existing models did not predict. In ordinary suburbs, in modest houses, in households where the car in the driveway was a 5-year-old pickup truck or a Ford sedan. These households were not glamorous. They were not what anyone would point to as examples of wealth. But the numbers in the financial statements were real. This was the question that the Millionaire Next Door answers. What is actually happening, financially, in the ordinary-looking households of America? And why are those ordinary-looking households so much more likely to contain genuine wealth than the spectacular-looking ones? The methodology of the Millionaire Next Door was straightforward but labor-intensive. Stanley and Danko conducted surveys of households with a net worth of $1 million or more. Over 2 decades, they interviewed and surveyed over 1,000 millionaires. They asked detailed questions about income, spending, saving, investment, lifestyle, and attitude toward money. They then compared what they found to what popular culture and the financial services industry said about wealthy people. The discrepancy was dramatic. Popular culture defined wealth by display, by the car you drove, the house you lived in, the restaurants you ate at, the vacations you took. The financial services industry targeted affluent consumers based on income, people who earned a lot of money. Neither of these proxies reliably identified actual wealthy people. The data showed that high income and high net worth were not the same thing. Many people who earned $300,000 a year had a net worth of less than $100,000. Many people who earned $80,000 a year had a net worth of several million. The difference between these groups was not income. It was the ratio of income that was saved and invested versus the ratio that was spent. This seems obvious when stated plainly, but the degree to which popular culture and the financial services industry had gotten it backwards was striking. The most reliably identified wealthy people were not in the glossy suburbs. They were in the ordinary ones. Stanley and Danko identified 7 common denominators among the millionaires they studied. These were not universal. Every case had individual variation, but they appeared with sufficient consistency across the data to be treated as genuine patterns. The first was living well below their means. This was perhaps the most consistent finding in the entire study. American millionaires spent substantially less than their income allowed. They lived in houses worth far less than they could afford. They drove cars that were modest relative to their financial capacity. They did not upgrade their lifestyle every time their income increased. In fact, the data showed that many had not significantly upgraded their lifestyle in years or decades. This is the opposite of what popular culture presents. Popular culture says that when you make more money, you live better. You get a bigger house, you get a nicer car, you take better vacations, you upgrade your wardrobe and your restaurants. The millionaires in Stanley and Danko's data generally did not do this. When their income increased, they saved and invested the difference. The house they could afford was not the house they bought. The second common denominator was efficient use of time, energy, and money in ways conducive to building wealth. This sounds abstract, but what it meant in practice was deliberate allocation. Millionaires in the study did not spend large amounts of time or money on things that did not contribute to wealth building. They were not lavish entertainment spenders. They were not impulse purchasers. They thought carefully about where money went, consistently, over long periods of time. The third was prioritizing financial independence over social status display. Stanley and Danko coined a phrase for this: "I am not what I drive." The millionaires they studied did not define themselves by their possessions or by what those possessions communicated to others. They did not feel the need to signal status through consumption. This is not merely a financial habit, it is a psychological orientation. And it is, the data suggested, essentially incompatible with high net worth accumulation in the consumer economy. The fourth was that their parents did not provide significant economic outpatient care. This is the term Stanley and Danko used for the pattern, which they documented extensively in later research, of wealthy parents subsidizing the consumption of adult children. Their data showed that parents who funded their children's expensive lifestyles, the house in the right suburb, the car that matched the neighborhood, were systematically undermining those children's ability to build wealth of their own. Children who received large subsidies spent at the level the subsidy allowed, saved at a lower rate than self-funded peers, and often did not develop the financial habits required for independent wealth accumulation. The fifth was that their adult children were economically self-sufficient. This was related to the fourth denominator, but distinct. The wealthy people Stanley and Danko studied had, in their own parenting, raised children who could support themselves. This was not always the same as withholding financial support entirely, but it meant that support, when given, was structured not to fund consumption, but to build independent financial capacity. The sixth was that they were proficient in targeting market opportunities. This was the least uniform finding in the study and the most variable. Some millionaires had built businesses. Some had made shrewd investments in real estate. Some had simply invested consistently in index funds over decades. What they shared was an active orientation toward wealth-building opportunities, not a passive acceptance of whatever income their employment provided. The seventh was that they chose the right occupation. This does not mean they chose the highest-paying occupation. The data was more nuanced than that. High-paying occupations, doctors, lawyers, investment bankers, appeared among millionaires, but so did business owners in unglamorous sectors. Pest control, welding supply, dry cleaning, flooring. The correlation was not between income level and wealth, but between choosing work that could generate income in excess of the consumption lifestyle the person chose to live. The most analytically useful concept in the Millionaire Next Door is the framework of the under-accumulator of wealth and the prodigious accumulator of wealth. Stanley and Danko constructed a formula for expected wealth given age and income. Multiply your age by your annual income from all sources, then divide by 10. The result is what someone of your age and income should have accumulated in net worth if they had been saving at an average rate throughout their working life. If your actual net worth is half or less of this expected figure, you are an under-accumulator of wealth, a UAW. If it is double or more the expected figure, you are a prodigious accumulator of wealth, a PAW. The middle is average. What the data showed was that PAWs and UAWs with comparable incomes lived completely different financial lives. The differences were not primarily about income or investment returns. They were about consumption. UAWs consumed. They spent to maintain a lifestyle that reflected their income level. They owned expensive homes in expensive neighborhoods, drove new or nearly new vehicles, ate at restaurants regularly, bought expensive clothing, took expensive vacations, and sent their children to private schools. None of these things are intrinsically wrong, but each of them requires money to flow out of the household rather than accumulate in it. PAWs accumulated. They spent significantly less than their income. The gap between income and expenditure was saved and invested year after year. The compound effect of this gap, sustained over decades, produced the net worth figures that placed them in the study. The comparison between two households with the same income, one a UAW, one a PAW, is illuminating. The UAW household looks wealthier. The cars are newer. The house is in a better suburb. The vacation photos are from more expensive destinations. The clothes are from better brands. From the outside, this household signals success. The PAW household looks ordinary. The car is old. The house is modest. The vacations are not exotic. From the outside, this household does not look wealthy at all. But the financial statements tell the opposite story. The UAW household, despite a higher income, has accumulated little. The PAW household, with the same income or less, has accumulated millions. This is the core paradox that the Millionaire Next Door documents. In the consumer economy, looking wealthy and being wealthy are not just different. They are often inversely related. The more you spend to look wealthy, the less wealth you accumulate. The consumption patterns of UAWs and PAWs extend to their children. Stanley and Danko devoted significant attention to this in their research, and the findings were disturbing for anyone who instinctively wants to give their children every advantage. When wealthy parents fund their adult children's expensive lifestyles, the mortgage in the right postcode, the new car every 3 years, private school tuition for the grandchildren, expensive vacations, they are providing what Stanley and Danko called economic outpatient care. And the data showed that this care has a deeply counterproductive effect on the recipients. Children who receive substantial economic outpatient care consistently save less, invest less, and accumulate less wealth than children of comparable income who receive no such support. The reason is logical. If you know that a financial buffer will appear when you need it, the urgency of maintaining your own buffer is reduced. The habits of frugality and savings that build wealth are not developed because they are not required. The data also showed that economic outpatient care tends to escalate. Families who begin by providing modest support find that the support, once established, becomes an expectation. The recipients structure their lives around the assumption that the support will continue. When the parent's wealth is eventually distributed as inheritance, it often disappears within a generation because the recipients have no practice in accumulating wealth and every practice in consuming it. The wealthiest families in the study, those with the most durable, generationally sustained wealth, were those who had deliberately structured the transfer of wealth to their children in ways that required the children to develop their own financial competence first. Not withholding financial support entirely, but providing it in forms that built rather than undermined financial independence. The occupational profile of American millionaires in the Stanley and Danko data was one of the most surprising findings for general readers. The majority of the millionaires in their study were not in glamorous or prestigious occupations. They were not actors, musicians, or athletes. They were not investment bankers or hedge fund managers. Many were business owners in sectors that most people would describe as boring. Janitorial services, insurance agencies, accounting firms, auto parts wholesalers, agricultural businesses, welding contractors. What these businesses had in common was not glamour, but economics. They could generate income above the cost of running them, profit. And the owner had the discipline to not spend that profit as fast as it arrived. The data showed that business ownership was the single most reliable path to high net worth in the United States. Not employment in a high-paying field, but business ownership, even in an unglamorous sector. The business owner who runs a pest control company and lives modestly, reinvesting profits into the business and savings, will typically accumulate more wealth over a career than a lawyer at a prestigious firm who earns 3 times as much but spends 4 times as much. Doctors appeared in the millionaire data, but not in the proportion that their incomes would predict. The medical profession is characterized by high incomes and high consumption. Medical school loans that take decades to pay down, the professional expectation of an expensive lifestyle, the peer pressure of colleagues with similar incomes who spend lavishly, the delayed start to savings because of the long training period. Many physicians earn more than most business owners in the study and accumulate less. This was another of the paradoxes the research documented. The professions that signal status most reliably, medicine, law, finance, are also among the professions that most effectively prevent wealth accumulation because the social expectations around lifestyle in those professions are extraordinarily expensive to maintain. The role of social comparison in wealth destruction is one of the less discussed aspects of the Millionaire Next Door, but one of the most important. Stanley and Danko found that UAWs were far more likely than PAWs to define their lifestyle relative to the people around them. If their neighbors drove a particular car, they drove a comparable one. If their colleagues lived in a particular suburb, they lived in one like it. If their friends took particular vacations, they aspired to similar ones. This is not irrational behavior. It is, in fact, the behavior that social evolution has wired into human beings. Status comparison is a fundamental mechanism of social cognition. We know our position in the social hierarchy by comparing ourselves to the people around us, and we adjust our behavior to signal appropriate position. The problem is that in the consumer economy, the people you are likely to compare yourself to, your colleagues, your neighbors, your social peers, are mostly UAWs. They are spending at or beyond their income level to signal status. If you compete with them in consumption, you will spend at UAW levels and accumulate at UAW rates. PAWs, in contrast, had either opted out of the status comparison game, the I am not what I drive orientation, or were comparing themselves to a different reference group entirely. Many had built their social lives around people with similar financial values, other savers, other business owners, other people who did not feel the need to signal status through consumption. This is not merely a financial insight, it is a sociological one. Who you spend time with shapes what you spend money on. The social environment is a financial determinant as powerful as income. The concept of hyperconsumption neighborhoods appears in the Millionaire Next Door as an explanation for why wealthy areas contain relatively few wealthy people. Stanley and Danko defined a hyperconsumption neighborhood as one in which residents are expected to maintain an expensive lifestyle as a condition of social acceptance. Expensive cars, large houses, private club memberships, certain schools for their children, certain restaurants, certain vacation destinations. These expectations do not have to be explicit. They operate through social pressure, status display, and the fear of being perceived as not belonging. In these neighborhoods, even people with genuinely high incomes find it difficult to accumulate wealth because the cost of maintaining the expected lifestyle consumes most or all of the income that would otherwise be available for savings and investment. A household earning $600,000 a year in a hyperconsumption neighborhood might spend $580,000 to maintain the lifestyle the neighborhood requires. The $20,000 surplus does not build significant wealth. The contrast with the ordinary suburb, where a household earning $200,000 might spend $120,000 and save $80,000, is stark. Over 20 years, the ordinary suburb household accumulates far more wealth despite earning a fraction of what the hyperconsumption household earns. This finding has a direct implication for anyone thinking about where to live. The neighborhood you choose is a financial decision as consequential as any investment you make. Moving to a more expensive neighborhood does not merely change your address. It changes the baseline of acceptable consumption for your household. And that change in baseline has compounding consequences that accumulate over decades. The millionaires in Stanley and Danko's study had several specific habits around money that distinguished them from UAWs with comparable incomes. They tracked their spending. Nearly all of them had some system, formal or informal, detailed or approximate, for understanding where their money went. This was not neurotic penny counting, it was deliberate awareness. They knew roughly how much they spent on food, on housing, on transport, on clothing, on entertainment. And that awareness allowed them to make choices about where to direct money rather than simply watching it disappear. They set financial goals. Most had specific targets: a retirement date, a net worth milestone, an income target from investment. And those goals shaped their financial decisions in the present. The goal was real enough that present consumption choices were made in reference to it. They owned rather than rented. Most of their homes were owned, not rented. This is not a universal wealth recommendation. There are circumstances where renting makes financial sense. But in the context of their overall financial behavior, ownership was a mechanism for forced savings. Each mortgage payment reduced debt and built equity, which accumulated alongside their savings and investments. Many of them did not exhibit any of the behavior that financial media associates with wealth building. They did not trade stocks actively. They were not sophisticated investors in exotic instruments. Many simply owned shares in established companies or index funds and held them for decades. The most reliable path to wealth in the study was not smart investing. It was consistent saving, followed by unremarkable long-duration holding. The chapter of The Millionaire Next Door that generated the most reader response was the section on the relationship between wealth and time. Stanley and Danko asked their millionaire respondents how they allocated their time across major categories of activity. They found that PAWs spent significantly more time on financial planning than UAWs with comparable incomes. This is intuitive if you think about it. Financial planning, understanding your current position, setting goals, deciding where to allocate savings, tracking progress, is the activity that produces financial outcomes. People who spend more time on it tend to produce better outcomes. This is not different from any other area of life. The athlete who spends more time practicing improves faster. The writer who spends more time writing produces more. The person who spends more time planning their finances accumulates more. But the finding that was more surprising was about leisure time. UAWs spent more time worrying about money than PAWs. Despite having less financial security, UAWs thought about money more anxiously, more frantically, in more reactive ways. PAWs had a more planful, less anxious relationship with money, precisely because they had constructed a financial life that did not require constant crisis management. Financial anxiety is the product of financial insecurity. And financial insecurity is, for most people in the middle and upper middle income brackets, the product not of low income, but of high consumption relative to income. The physician who earns $500,000 a year but spends $490,000 has more financial anxiety than the business owner who earns $150,000 and spends $80,000. The physician is one bad year from financial difficulty. The business owner is decades away from it. The long-term consequences of the patterns. The Millionaire Next Door documents compound over time in ways that are not immediately obvious but become dramatic over decades. Consider two households with the same income at age 30. Household A saves 15% of income every year. Household B saves 3%. At 30, the difference in wealth between them is small, a few $1,000s. At 40, it is noticeable. At 50, it is significant. At 60, it is potentially the difference between financial independence and financial dependence. The mathematics of compound growth means that small differences in savings rate, sustained over long periods, produce enormous differences in outcomes. A difference of 12 percentage points in savings rate does not produce a 12% difference in wealth at 60. It produces a difference that can easily be 300% or more, depending on investment returns and the time horizon. This is the financial logic behind the behavior of the PAWs in Stanley and Danko's study. They were not making large dramatic bets. They were not discovering secret investment strategies. They were simply maintaining a savings rate that was high enough for long enough to allow compound growth to do its work. The UAWs, by contrast, were consuming the compound growth before it could accumulate. Every purchase that exceeded what was necessary for a dignified, comfortable life was a consumption of future wealth. Every upgrade in car or house or clothing that was driven by status comparison rather than genuine need was a subtraction from the accumulation that would eventually produce financial security. Over decades, the lifestyle that looked wealthier in the present produced outcomes that were dramatically less wealthy in the future. The Millionaire Next Door was published 30 years ago. The specific numbers have changed. $1 million is not what it was in 1996, and the distribution of income and wealth in America has shifted substantially since then. Some of the occupational data is specific to its time. Some of the findings about economic outpatient care were refined and revised in Stanley's subsequent books. But the core findings have not been invalidated by the passage of time. They have been replicated in research conducted in other countries in other decades with different demographic profiles and different economic conditions. The pattern that Stanley and Danko identified. The fundamental gap between wealth accumulation and wealth display. The destructive role of social comparison in financial outcomes. The power of sustained frugality over long time periods. The counterintuitive finding that high consumption lifestyles systematically prevent wealth accumulation even at high income levels is not a product of any particular time or place. It is a product of how compound growth works and how human beings respond to social comparison. If you live in a country with a market economy, access to employment, and some capacity to save, the principles of the Millionaire Next Door apply to your financial life. They are not comfortable principles. They require accepting, on a daily basis, a lifestyle that may be substantially less impressive than your income would allow. They require resisting the social pressure of a consumer culture that equates spending with success. But the data is clear about where those principles lead. Not to the flashy house and the new car and the expensive vacation. To the ordinary house in the ordinary suburb, the old pickup in the driveway, and a financial statement that would surprise anyone who judged by appearances. The Millionaire Next Door does not look like what you expect. That is exactly the point.